The US government has borrowed and spent over $10 trillion in deficits over the last 5 years. All of this new money is creating new money in the system, and it is driving inflation. Today, we are going to dive into the balance sheet operations to understand better how all this money is being created. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's episode, we are going to continue our series about money printing, Michael Howell's global liquidity framework, and how banks create money to finance all of this Treasury deficit spending. Okay, in this first example, I'm going to present to you 4 balance sheets throughout this episode: the Treasury, the Fed, the commercial banking system, and a hospital. Now, in this example, we are going to think about the hospital as the first recipient of Treasury spending, in that Medicare is one of the largest line items for the federal government, and hospitals throughout the country are the beneficiaries of a lot of these Medicare payments before they use that money to administer care. So the hospital is our private sector balance sheet here. Now, in the first example, I have Treasury is issuing T-bills but not spending money. Now, this is from a liquidity perspective, what we have come to know as a build of the TGA. So this is when the Treasury General Account increases in size. Now, in this example, I have only a cash build at the Treasury. So this is going to be a net negative of liquidity from the Howellian version of liquidity perspective, as we think about liquidity leaving the system when the Treasury issues money but doesn't spend it. It's taking money out of other investments and putting that money into Treasury instruments. The Treasury instruments, though, are not being used to spend money into the economy in this example. So the first balance sheet, Treasury, you can see I have plus T-bill on the liability side. That is the issuance of a T-bill to raise money. And then the TGA rises. The TGA is the Treasury General Account. That is an account at the Fed for the US government. That's the US government's checking account. So the government issues a bill and raises money. So that's why you see plus T-bill and a plus TGA. So in this example here, I am showing you a bank buying this bill, but not using any credit mechanism. It is simply using reserves that it already had to buy a bill. So this is an asset swap for the bank. So you see on the commercial banking side, the commercial bank gains the T-bill and transfers the reserve to whatever bank it's settling this Treasury with. So in this way, the T-bill is added to the commercial banking system, but the reserves are debited because that money was already in existence in this example. Okay, now you look at the Fed's balance sheet. The Fed has a build in the TGA and a debit of reserves, as this bank has debited reserves in order to gain a T-bill. So that's how these 3 balance sheets balance. We have no new money being created in this example. We are only seeing the Treasury issue a Treasury instrument but not spend that money into the system. And the purchaser of that Treasury was a bank that did not create any credit to do this. It was already using reserves that it had. The Bitcoin Layer is sponsored by River. River is a Bitcoin-only exchange if you guys are looking for a place to get allocated. Go check them out today at river.com/TBL for a special offer of up to $100 in Bitcoin for free when you purchase. The most important thing about River is that River does not use a third-party custodian for Bitcoin. That means when you purchase Bitcoin on River, River has its own storage solution and is not relying on any third party to custody that Bitcoin. It also means that they have an amazing technical expertise. It's a great team over there at River. Go check them out, river.com/TBL. Okay, in this next chart, this is the one that you guys asked for. Remember to subscribe to our free research publication at thebitcoinlayer.com/subscribe for all of our latest research. And TBL Pro members are able to request custom analysis. So this came in from a pro member out there. He was asking about this process of banks monetizing T-bills. He's trying to understand the balance sheet mechanics. Where does the cash come from? Where is the new money being created? So I have a balance sheet operation here to show you guys how that whole process works. So the title of this one is Treasury issues T-bills and then spends, and the T-bills are monetized by banks, which means new money is being created to finance these bills. So how does it all happen? And instead of thinking about, okay, the Treasury issues and then it spends and then the hospital gets the money and then the hospital's cash does something into the system, we try to think about all of these things happening at the same time, because for the banking system, that is how the banking system processes these transactions. Okay, let's start with the Treasury Department. The Treasury Department is raising a T-bill, so that's a liability for the Treasury. It now owes money to whoever is going to hold that bill. And then the Treasury raises funds, so its checking account goes up. That's a plus TGA. And then it spends that money right away. So that's the minus TGA. So in this way, the Treasury Department has raised money and spent it right away. So an increase in debt for the government with a spend going out into the system. Who does that spend go to? In this example, we are going to imagine that the spend is a Medicare reimbursement, and so it ends up as a deposit on the balance sheet of the hospital. So that's why you see the hospital now has a larger balance sheet because it received a new payment, a brand new reimbursement payment from the government. So the hospital deposits go up and net worth for the hospital's balance sheet goes up because that new deposit does not come with a debt. It is not paired with a debt. It is new net worth. So the balancing operation is an increase in equity. Okay, so in this way, we are looking at the Treasury Department spending money, that's the minus TGA, plus deposits. When the Treasury spends money, it ends up as a deposit in a bank account somewhere in the commercial banking system, and the hospital gains in net worth. Okay, so how does a bank monetize the T-bill here? How does all of this happen? Let's move from the hospital to the commercial bank. What happened at the hospital? The hospital gained a deposit. Where does that deposit now exist in the financial system? It's a liability of the commercial bank. So the hospital banks with this commercial bank. Let's say it's Wells Fargo. Wells Fargo will gain a deposit on its liability because the government just sent the money to this this hospital. The hospital gains a deposit. Wells Fargo then gains a deposit on its liability side. But then what happens to the asset side of the commercial bank of Wells Fargo here? Is the government sending reserves to Wells Fargo to finance that deposit? No. So this is where it gets a little tricky here. And that's why we need 4 balance sheets to really understand what's happening. So now let's focus on the commercial bank asset side of the balance sheet. Now, what happens to the asset side of the commercial bank here? I have a plus T-bill here, but under the hood, what's really happening is that when the government sends the hospital a direct deposit, the hospital has a new deposit at the commercial bank, Wells Fargo. And then on the asset side, what's happening with Wells Fargo is that Wells Fargo is gaining a reserve from the Treasury Department when the Treasury spends money and then creates a reserve balance at the Fed. So let me say that again. The reserve balance at the Fed goes up when the Treasury spends money. So when the Treasury spends money, what you automatically have happen is that the quantity of reserves in the system goes up because the Treasury's general account is on the Fed's balance sheet. So, but in this example, we have the Treasury building money and then spending it right away, doing what to reserves? Doing nothing to reserves. So reserves don't change here. And that cash raise at the Fed on the liability side is offset by the spend. So when the Treasury issues a bill and raises money and then spends it right away, the quantity of reserves at the Fed does not change at all. And in this example, I have the commercial bank that's going and buying the T-bill. So the commercial bank shows up to the auction. It buys the T-bill. It puts the T-bill on the asset side of its balance sheet. Now, does it send reserves to the Treasury via the Fed's balance sheet? No, it doesn't have to, because in this example, and this is the key, this is what people miss, is that Wells Fargo bought the bill, but Wells Fargo's client is the hospital. So Wells Fargo buys the bill. Now you can work backwards. Wells Fargo buys the bill. The cash goes to the Treasury Department. The Treasury Department spends it to the hospital. The hospital deposits the money at Wells Fargo. And so Wells Fargo bought the bill, but issued a deposit to the hospital, creating brand new money into the system. So look at now the commercial bank's balance sheet in isolation. Wells Fargo buys the bill and issues a deposit to the hospital. When it issues the deposit to the hospital, you can think of it as, if you remember our examples of creating money when a bank issues a loan, it just does plus deposit and plus loan on its asset side. Well, here we have the commercial bank doing plus T-bill on its asset side, buying the T-bill from the Treasury, plus deposit, but it's not giving the deposit to the government. It's giving the deposit to the hospital, who was just paid a reimbursement from the government. So you have to think about the private sector when thinking about how the banking system monetizes T-bills, meaning creates new money to finance the issuance of government debt. So now look at the Fed's balance sheet. What happens to the Fed's balance sheet? Nothing. Reserves don't change. TGA builds and TGA declines when the Treasury issues a security and spends the money. So we don't need the Fed. That's why when the government borrows and spends, it's creating money. It is printing money because it's printing the deposit at the commercial banking system. And when there are more deposits in the system, that is more available money for people to spend that didn't exist before. I will show you an example shortly of something a little different when we don't have T-bills being monetized, but we have money coming out of the system that already existed to purchase T-bills. But in this example, this is brand new money. So hopefully this answered the question of how money is created when banks buy bills. You have to think about the private sector too, and the private sector being the recipient of the stimulus payment or the Medicare payment or the defense contractor payment. Now, in this example, I have Treasury spends but doesn't issue. This is the famous TGA spend down creating liquidity. So we have had some people speculate that the Treasury can use its Treasury general account to influence liquidity. This is that example here where the Treasury is not going to issue new securities, but it's going to just spend money and run its TGA balance lower. Now, remember, when the TGA spends money, what happens to the reserve balance at the Fed? It goes up. And so this is what we are seeing here, that the Treasury spending money without issuing debt is technically a pay down, and it is going to cause liquidity to come into the system. So now I have on the Treasury balance sheet a decline in its spending. And the implied right side of the balance sheet is the pay down. So it's a minus T-bill, or just a decline in overall Treasury debt. That's the 35 trillion we have. It'll go down in this scenario. So Treasury spends money. What happens at the Fed's balance sheet? TGA goes down and reserves go up. So when the Treasury spends money, where does that money end up? It ends up in the hospital's checking account. So the hospital has plus deposits, plus net worth, just like before. The hospital gains money. We have new money in the system. That's why it's net positive to liquidity when the Treasury spends money and doesn't issue. So the deposit goes up at the hospital. It goes up at Wells Fargo in the commercial bank. But what happens to the commercial bank's asset side? It gains the reserve that happened at the Fed's balance sheet. So Treasury spends, TGA goes down at the Fed, reserves go up because the commercial bank gains a reserve when it gains a deposit from the hospital. This is no issuance here. This is just a spend down, so it's a pay down of debt. It's an increase in deposits in the private sector. And for the commercial bank, it is an increase in the size of the commercial banking system because it does gain new reserves. Okay, in this next chart, I have Treasury issues, and the new T-bill is purchased by a money market fund. So the Treasury issues by adding a T-bill to its balance sheet, so more debt raises cash plus TGA. At the Fed, we have a build in the Treasury's general account being offset by a debit of reserves, so that those reserves come out of the banking system. So where does the money come from then to buy the T-bill? Who buys the T-bill? We have the hospital here marked, but remember, the hospital now also has its own money market fund account where the hospital is using some of its cash balance to put back into the system. So in this example, we have here the hospital's money market fund account purchasing the T-bill. Now we are assuming here that the hospital already had deposits. So let's imagine that it had received money from the Treasury Department in reimbursement. So it had deposits. It now spends those deposits on a T-bill. Nothing happens to the hospital's net worth because the hospital already had money, and now it uses that money and buys a T-bill. So the hospital loses a deposit, gains a T-bill. The commercial banking system then loses a deposit and loses the reserve because the Treasury and the hospital now, the Treasury and the money market fund are in business together. The hospital owns the T-bill. It doesn't need the banking sector anymore. That's why we lose assets and liabilities from the commercial banking sector. And because we have the commercial banking system losing money, the Treasury Department gaining money, nothing happens at the Fed. Now, in this last example, I bring in repo. You guys know we try to talk about repo in almost every single piece of content that we do because repo sits at the heart of the entire financial system. It is the wholesale funding that makes the whole thing tick. So, repo in this example here, Treasury issues, the primary dealer buys, and the money market fund finances the purchase of the dealer Treasury purchase through the repo market. Now, I want to point your eyes all the way to the right hand of the screen right away. Is there new money being created or new net worth being created here? No. the hospital's balance sheet does not change here, and I think that's very important here. The repo market must come from somewhere, in that we don't have brand new money being created in the repo market to finance the Treasury Department. That sort of repo financing can create new money for the financing of other securities, but not Treasury securities, because Treasury securities must settle via, ultimately, the Fed's reserve balance and Treasury general account mechanism. So the Treasury here issues a T-bill, and that T-bill is purchased now by the primary dealer. So now I have the primary dealer and commercial bank combined onto one balance sheet. The primary dealer gains the T-bill here. So you have primary dealer plus T-bill. But the primary dealer is growing its balance sheet in order to purchase this treasury. It's not financing it from something it already has. Where does it get the money? It gets the money from a repo contract from a money market fund. So plus repo to finance the plus T-bill at the primary dealer level. Then you go to the hospital's balance sheet. The hospital balance sheet is going to, it already has money now. So it's going to minus deposits and plus repo. It's going to take money it already has, and it's going to finance the dealer. So it gains a repo agreement where it basically is due interest the next day. So that's why a hospital doesn't change the net worth, subtract deposits and add repo. Now, when it subtracts deposits, where did those deposits come out of? It comes out of its commercial bank. So now to Wells Fargo. So it takes money out of its Wells Fargo deposit, purchases a repo contract with the dealer, so takes money out of Wells, sends it to the dealer. The dealer uses that money to buy the T-bill. The T-bill is now going into, or that money goes into the Treasury's general account. And because Wells loses the deposit, it loses the reserve that offsets the TGA build at the Fed. So in this way, when the Treasury issues and the money market fund finances a dealer purchase of Treasuries, we have no change in the Fed, no change in the overall banking system, because you have no change in the net worth of the hospital here. You're simply having the hospital rotate out of deposits into repo, rotating out of a commercial bank liability into a primary dealer liability. And the banking system losing a reserve when the deposit goes out of the commercial banking system to finance the dealer, that money that leaves the commercial banking system is offset by the Treasury taking that money onto its own balance sheet. Hopefully, these 5 examples were helpful to you guys. Now I'm going to rely on your follow-up questions. I've tried to break down even more how banks create money when they buy T-bills, how some of Michael Howell's global liquidity framework works in terms of the TGA building, drawing liquidity out, and the TGA spending, putting money into the system. And now hopefully you understand that the Fed doesn't necessarily have a role in a lot of the Treasury deficit spending. The Fed's balance sheet almost doesn't even get touched, except for maybe some intraday or one day after settlements between banks. In the end, the size of the Fed's balance sheet doesn't change. So in this way, we really are seeing how much influence credit providers, the commercial banks, have in buying T-bills, adding those T-bills to their balance sheet. I promise you that I'm going to do another episode on shadow banking and shadow banking reserve settlement, how shadow banks use repo and use other mechanisms to delay the settlement of reserves throughout the system. We'll also add in the Eurodollar system when we explain that. Make sure to subscribe to this channel. It goes a long way for us to get our videos to you as soon as possible, so please subscribe. If you happen to listen on audio, please make sure to rate and review there. That also goes a long way. Subscribe to our free research publication at thebitcoinlayer.com/subscribe, and we'll catch you guys next time. The Bitcoin Layer is proud to be sponsored by River. River is a Bitcoin-only exchange, and we think it is the best place for you guys to get allocated if you have made that decision to purchase Bitcoin. So go check them out at river.com/TBL for a special offer of up to $100 in Bitcoin for free when you purchase.